Welcome to this audio webcast discussing Saudi Aramco's half-year 2023 results. I'm Peter Hutton, Head of Investor Relations at Aramco. And it gives me great pleasure to be joined today by our CEO Amin Nasser and CFO Ziad Al-Murshed. Our webcast today will comprise a presentation followed by a question and answer session, and we anticipate the entire call lasting up to an hour. I would also like to remind you that this webcast and conference call are being recorded and to draw your attention to this cautionary statement. During today's presentation, we may make forward-looking statements that refer to estimates, plans and expectations. Actual results and outcomes could differ materially due to factors we note in this slide. Please also refer to our regulatory filings and website for more details. With that, I will now hand the call over to Amin.
Thank you, Peter. Welcome everyone, and thank you for joining us today. As Aramco marks its 90th anniversary, I am pleased that the company continues to deliver strong performance. This continued success is driven not only by the quality of our asset, but also by the focus and dedication of all my colleagues and our wider stakeholders, and I offer them my sincere thanks. With the second half well underway, we are looking ahead with further confidence and optimism that our expansion and growth strategy will help meet the world's energy needs and our ability to maximize long-term value for our shareholders. Aramco continued to deliver strong performance in the first half of 2023, and our growth strategy remains on track. Our high reliability, high flexibility, and low cost of production underpin our ability to generate strong earnings and cash flows and a robust balance sheet. This further demonstrates our ability to deliver through oil price cycles. Despite the market volatility, short-term global oil demand forecasts show signs of improvement. Oil demand is expected to reach record levels of over 103 million barrels per day by the end of this year, reaching pre-pandemic highs with further growth expected thereafter. We continue to expect that oil demand is likely to grow in the mid to long term. With our increasing confidence in these fundamentals and further progression into the cycle, together with steady execution of our largest capital program and strong financial position, we have today announced our intention to share even further upside with investors through our performance-linked dividend. We are announcing this earlier at the top end of the announced range and on a higher cash flow base. Ziad will cover more of the details shortly. Let me now turn to our progress in delivering on our strategy. Our strategy is to invest in our growing integrated portfolio by remaining the world's preferred supplier of conventional low-cost, lower-emission upstream energy, and at the same time, build leadership positions in low-carbon fuels and solutions. This strategy is on track, and we are delivering our milestone through the largest capital program in our history by investing in upstream, downstream, and low-carbon fuels and solutions. In upstream, we are capitalizing on the need for ongoing investment in our oil expansion, and we are increasing gas production by more than 50% by 2030 to meet increasing demand, generating additional liquids for export, and enabling a blue hydrogen value chain. Our downstream business is focused on capturing integration benefits and de-risking upstream. We have made major investment in Asia to support our liquid-to-chemicals throughput to 4 million barrels per day. We are advancing the development of decarbonization options with our focus on low-carbon fuels and solutions, with shipments of ammonia to key markets and investment in PV solar projects. Also, through our investment in the national ecosystem of thriving businesses, we are both increasing local content and increasing Aramco's supply chain resilience and flexibility. All of this is being done from a position of financial strength and competitive advantage. Overall, we are pleased with the progress we are making. With that, let me now hand over to Ziad to discuss the details of our first half 2023 performance.
Thank you, Amin. Welcome, everyone, and thank you for joining us today. I want to start from where Amin ended, so I'll detail our key strategic achievements during the first half, to which Amin alluded, and then I'll move on to financial performance and dividends. We're progressing very well in executing our strategy, and we are on schedule with our record capital program. Our guidance remains unchanged at $45 to $55 billion for this year, and the profile going forward is also unchanged, increasing to peak around mid-decade. Specifically, in upstream, our crude oil capacity expansion plans are on track, with planned progress being made in engineering, construction, and procurement activities on our crude oil increment projects. The first increment from the Dammam development is expected to be on stream by the end of next year, followed by Marjan and Berri fields in 2025 and Zuluf by 2026. In gas, key milestones are being delivered to achieve our target to increase gas production by more than 50% over 2021 levels by 2030. Progress continues to be made on the Harad and Hawiyah gas compression projects, both of which are expected to reach full capacity this year, with 5 of the 9 plants already completed, followed by the Tanajib gas plant, which is part of the Marjan development, to be on stream by 2025. In unconventional gas, design and construction activities continue on the Jafurah field and gas plant, which are planned to start production by 2025. We also commissioned the Hawiyah Aneza gas storage facility and are proud to announce that the maximum injection target was reached. This is the first underground natural gas storage facility of its kind in Saudi Arabia. Our downstream strategy is also underway by continuing to grow our presence in key markets and to direct up to 4 million barrels per day of our liquids into a dedicated liquids to chemicals portfolio. On the domestic front, EPC contracts were awarded for the $11 billion Amaral complex, which is a new world-scale petrochemical facility at the Satorp refinery in Jubail that is expected to have one of the region's largest mixed-feed steam crackers. Internationally, we recently completed the strategic acquisition of a 10% interest in Rongsheng Petrochemical Company in China, and we broke ground on a new refining and petrochemicals complex also in China. These 2 investments will enable Aramco to supply about 700,000 barrels per day of crude oil to high chemical conversion assets in China. In addition, S-Oil broke ground on our largest investment ever in South Korea to develop one of the world's largest refinery integrated petrochemical steam crackers, pioneering our thermal crude to chemical technology. We also completed our acquisition of Valvoline's global products business, thereby advancing our international lubricants growth strategy. In low carbon fuels and solutions, the group entered into a consortium to invest in the development of 2 PV solar mega projects that are expected to have a combined capacity of 2.7 gigawatts, which puts us well on our way to achieve our target of 12 gigawatts of renewables by 2030. Also, the group partnered with Total Energies and successfully converted oil derived from plastic waste into internationally certified circular polymers for the first time in the region. We also successfully delivered 3 shipments of accredited lower carbon ammonia to several key markets for both fertilizer production and power generation, and we signed an agreement with Linde Engineering for developing new ammonia cracking technology, further supporting lower carbon energy solutions. Finally, on lower carbon fuels and solutions, we were the lead bidder in the largest ever voluntary carbon credit auction, which reflects our focus to offset some hard-to-abate emissions. Our localization effort continues to strengthen our local supply chain through our Nama'at program. We signed an agreement with Baosteel and the Public Investment Fund of Saudi Arabia to establish a steel plate manufacturing complex in Saudi Arabia. This is the first facility of its kind in the region, helping to localize our supply chain and reduce our reliance on imported steel. We also signed an agreement with DHL Supply Chain for a new procurement and logistics hub in Saudi Arabia to enhance supply chain efficiency and sustainability for the industrial, energy, and petrochemical sectors. Financially, we continue to optimize our capital structure with a cross-cycle view, so we balance between optimum WACC, credit rating, and financing needs throughout the years of the cycle. In that regard, we continued to smoothen our debt maturity profile by prepaying all remaining notes related to the SABIC acquisition. This not only significantly smoothened our debt maturity profile, but also generated savings of $2.8 billion during the first half of the year, which translated into a net gain of $1.5 billion. Overall, we are progressing very well on our strategy. Turning to our key operational and financial highlights for the first half, we generated $62 billion of net income and a free cash flow of $54.1 billion. We also paid $39 billion of dividends in the first half, which is a 4% increase in our base dividend, which we've always said would be sustainable and progressive. And we have also announced our intent to introduce a mechanism for sharing more upside with our performance-linked dividends. At the same time as increasing our base dividend, we further reduced our balance sheet gearing to negative 10.5%, down from negative 7.9% at the start of the year. Our ongoing focus remains on maintaining a high investment-grade credit rating across oil price cycles. As I mentioned earlier, we are progressing well with implementing our growth plans. Our capital investments are essentially on plan, amounting to $22.4 billion during the first half, including external investments, which is about 30% higher compared to the same period of last year. Our full-year capital investment guidance remains unchanged at $45 to $55 billion. Our financial results in the second quarter remain solid compared to the first quarter, despite the softer market environment. Upstream EBIT was strong at $56.7 billion, a bit lower than in Q1, in line with the reduction in average realized oil prices. This was partially offset by seasonally higher gas production in the second quarter. Downstream EBIT was $800 million in Q2, which is down throughout the first half compared to the same period of last year, mainly due to weaker chemical and refining margins, as well as negative inventory valuation movements resulting from much lower prices compared to last year. Group net income in Q2 was very close to that of Q1 when you consider that about half of the difference in net income between the two quarters is actually due to the higher gain on prepayments of debt achieved in Q1 and not due to underlying performance. ROACE, which we report on a 12-month rolling basis, was 25.9%. Overall, despite market softening, we delivered robust performance in the first half with the ongoing ability to capture the upside. And speaking of the upside, let me cover the wider business environment before I turn to dividends. Economic forecasts continue to improve, with global GDP growth trending back towards the 10-year pre-pandemic historic average. Monetary policies of central banks across the world have helped to moderate inflation levels, and we are clearly seeing inflation moderate, although it is still relatively high compared to historic levels. Having said that, we see oil demand continuing to be resilient, and the consensus is for high growth and a significant increase in demand in the second half of the year from a range of independent forecasters, including the IEA and others, as you can see in the chart. This increase is expected to come from several key areas and not just from China. China's demand has already been stronger than expected, with the first half of 2023 already above 16 million barrels per day. This is 1 million barrels per day higher than the same period last year, and more than 2 million barrels per day higher than the pre-pandemic levels. Okay, this brings us to our announcement on performance-linked dividends. First, I want to remind you of our dividend framework, which is designed to maximize shareholder value by providing downside protection through a sustainable and progressive base dividend, and a mechanism to share the upside with shareholders through a performance-linked dividend, all while heavily reinvesting in the business through unique growth opportunities. With the results of the fourth quarter of last year, we increased the sustainable and progressive base dividend from $75 billion to $78 billion. With the results of the first quarter of this year, we introduced a mechanism for performance-linked dividends and sharing further upside in the range of 50 to 70% of the group's annual free cash flow, net of base dividend and other amounts, including external investments. Today, as a result of continuing strong performance and stronger financial position, we are announcing the decision to increase performance-linked dividends in three ways. First, the first performance-linked dividend will be based on the combined annual results of 2022 and 2023. This results in a significant increase in performance-linked dividends as a result of including the record free cash flow of year 2022. Second, this first performance-linked dividend is based on 70% of the group's annual free cash flow, net of the base dividend and other amounts including external investments. This is right at the top of the announced range of 50 to 70%. And third, because we are combining year 2022 performance with 2023, we are paying the performance-linked dividend much earlier, starting in the third quarter of 2023. The payment of the first performance-linked dividend is intended to be distributed over 6 quarters in order to take us through to the fourth quarter of 2024, after which we intend to base performance-linked dividends on the full year results of 2024 and distribute over 4 quarters as previously announced. When we do the maths on 70% of the combined free cash flows of 2022 and the first half of 2023, after deducting base dividends and external investments, and then divide the total over 6 quarters, the result is a first payment of around $10 billion, which will be paid in the third quarter of 2023. We will then adjust future payments based on actual performance through to the end of 2024. After that, as I said, for year 2024 performance and onwards, performance-linked dividends would be determined based on full year results of each year within the previously announced range of 50 to 70% and distributed over the subsequent 4 quarters. This announcement demonstrates the strength of our balance sheet and our previously communicated plans to share excess cash balances with our shareholders. Like we always said, we are only building cash balances to ensure ability to fund our growth plans, and when we are comfortable with that, we would distribute excess cash to our shareholders. Now, it is important to keep in mind that all dividends are at the board's sole discretion, after considering our financial position and ability to fund commitments, including growth capital plans, in accordance with the company's dividend distribution policy. In summary, we have continued to deliver strong results both operationally and financially in the first half of the year. We remain focused on delivering shareholder value through fiscal discipline applied to a unique set of attractive growth opportunities, through diversifying financing sources and optimizing capital structure across the business cycle, and through enhancing distributions in a way that provides protection on the downside and sharing of the upside. Thank you very much for your attention, ladies and gentlemen.